guys, it's Preston Vanderbilt here, and I'm back with another binary options video for y'all today. Today we're going to take a further look into better understanding binary options volatility. We will cover the basic definition of volatility, the two types of market volatility, and some basic one-on-one information regarding market volatility. What many people fail to realize would be that market volatility is a direct result of the market's price action. For those of you unfamiliar with the basics of price action though, price action is simply the summation of all buy and sell orders during any duration of time. This duration of time can fluctuate from 1 second all the way to a tangible number before infinity. A little bit more information regarding price action would be that it is the direct derivative of order flow. Now, I plan to cover these topics more in depth later down the road for you guys, but for the sake of time today, we're just going to cover some of the basics about market volatility. Volatility is the tendency and probability that an asset will change directions due to minor or severe fluctuations in market conditions. When the buyers and sellers, otherwise known as the bulls and bears, are fighting for control over the market can become what I call choppy, basically meaning that the direction of the targeted asset becomes much more difficult to predict. Large press releases and other significant political events can have a huge effect on market volatility as well. Assets that display low volatility are assets that tend to be less prone to change directions due to minor fluctuations in the market. These low volatility assets tend to be easier to predict since they are less prone to change directions. High volatility assets, on the other hand, are more prone to change directions due to variations that may occur in market conditions. It is also imperative to understand that when it comes to investing with short-term options, that market volatility will play a considerable role in your success. Another thing to keep in mind with market volatility would be that currency pairs are perhaps the most susceptible assets that can be affected due to volatility. Now, finding a reliable trading strategy that considers volatility can be extremely difficult, but luckily enough for you guys, my channel is full of low volatility currency pair trading strategies. Now, there are two types of market volatility: historical and implied. Historical volatility is how the price of an underlying asset has changed during a certain time frame, while implied volatility is how the market currently expects an asset to perform in the future. Historical volatility tend to have a strong tendency to return to the mean, meaning the usual, making price action more predictable. Now, when a high level of implied volatility is present, assets become significantly more difficult to accurately predict, which is why having a solid trading strategy is imperative. For those of you looking for a reliable trading strategy that considers volatility, I have a bunch of them on my channel, and I will make sure to include them in the description box below for you guys. Also guys, if you have any questions regarding this video, market volatility, price action, order flow, anything trading related, please feel free to contact me at any time at prestonvanderbilt@gmail.com. Also below the video, I'll include some links to brokers where you can get $150 back, along with money back with the best performance signal services. As always guys, thanks for watching and stay tuned for more videos to come.